Hello, everyone, and thanks for joining me. Today, I will cover the Athabasca Oil Corporation recent slide deck with the community. We'll share it on YouTube. And we're going to just go into the details of what this company is up to. This is by no means a recommendation or financial advice. I'm not a financial advisor. This is simply a review of where the company currently stands based on their publicly disclosed slide deck. And to better understand the numbers, this is more of the purpose for this is information only and study of the publicly available data. So let's kind of dive into what we're seeing. So in the initial slide, you see their pad here, one of the pads. You see basically their kind of SAGD setup, and you see the facilities at the bottom there. And what you see here is steam injection that go into the pad and emulsion that's been produced led back to the surface facilities that probably look this way. So corporate snapshot, just really reviewing what the company is up to. So, and again, the date here is 2025 budget, and this was shared on December 5th, 2024. So the company, as you know, been busy buying back shares, and what I really care about in the current standing is that the basic amount of basic shares is 533 million. And I saw on Twitter recently that somebody shared that they bought a bunch of shares back this quarter, and it seems like the number right now is about 528. But don't take my word for it. You look at this 533 as kind of the official statement by the company. The market cap at roughly $5 per share. Currently, as I make this video, is about $5.50 per share. But the market cap is about $2.7 billion Canadian. One of the bigger stories that happened in 2024 is the devalue of the Canadian dollar. So it's kind of interesting because the company is like spending money in Canadian dollars. The stock is trading in Canadian dollars, but the oil price is trading in US dollars. And they buy back shares also in Canadian dollars, which is, it's just reality of things. So the FX plays an important role. But long story short here, basically the enterprise value is, I would say, 100 million less than the advertised market cap. So as of this slide, it will be like 2.6 billion, but now it could be closer to 2.8 billion because the share price appreciated. And why am I saying that? Because they have actually net cash position of 135 million, and the actual cash is 335 million. So basically, the debt is about 200 million. Sorry, I said, I'm pretty sure I said million, but yeah, so 135 million, 335 million in cash, and so the debt is minus 200 million. This is kind of unique to this company because what they've done is essentially kept cash on the books and kept debt on the books as well. And that gives them flexibility, I think, to buy back shares and kind of maybe like financial flexibility to do more with that money in the future and advance their kind of expansion plans as well, which is a cool thing. And at the same time, maybe there's a little bit of a PTSD kind of from the downturn. And so they have a lot of flexibility with that debt. And this year in 2024, they also refinanced that debt to I think it's about 6.7%, something like that. So fairly low rate on the debt, not to be matured anytime soon. So that's pretty good. So on thermal oil, production is 33,000 to 34,000 barrels per day. And this entity DEC, so Duvernay Energy Corp. So Duvernay Energy Corp is about 3,000. That's the production. So overall production is 38,500 BOEs per day, so barrels of oil equivalent per day. And the reason why they're looking at barrels of oil equivalent is because of Duvernay. It's kind of like a soup of hydrocarbons that being produced versus their Hangingstone and Leismer assets, where it's really like bitumen, so BBLs, barrels of oil. BBLs, essential barrels of bitumen. So, and here they say that 98% liquids from that composition of 38,500 BOEs per day. From thermal side, they suggest they have predictable low decline projects, which they do. Hangingstone is doing really well. I think current production in Hangingstone is about 7,500 A very small decline from previous month of about 0.5%. Seems like their asset called Leismer is doing really good. It's about 26,000 barrels a day as we speak, but it could be increasing here with kind of their development program. So the overall assets are doing pretty good. So just between what I shared as of previous month, it's about 26,000 plus 7,500. We're getting about 33,500 plus 3,000 here, so already 36,500, right? Based on just kind of quick math in my brain. So things are looking pretty good, I would say. And yeah, let's kind of continue reviewing what they're sharing. Efficient brownfield SAGD development. So we're going to see more in the slides about their brownfield development, but they basically communicated they're going to be expanding. I think they drilled already 2 well pairs in Hangingstone, basically to sustain production, and that PED L8 expansion in Leismer. But also we're going to see some more brownfield expansion plans to get that asset Leismer to 40,000 barrels a day, which will be a very big initiative for them, and not too bad, not too expensive. I think it's about 25,000 per flowing, my understanding, but we're going to see the actual numbers pretty soon. But I think it's good money, well spent, in a sense where they will become a mini MEG in a sense, right? So SAGD development, a MEG is about 100,000 barrels per day development. They'll have 40,000. So they'll have this unique asset, Leismer, that produces flow rates that are fairly rare for SAGD infrastructure in Alberta, where I think a lot of the assets that I monitor, they're about 20,000 barrels per day and smaller. So they do have long reserve life resources. So this oil is going to get produced for a very, very long time. I think Hangingstone is about like 30 something years, and I don't know, 50, 60 years of reserve, something like that. Leismer, really high numbers. I shared them in the past in my previous videos. So this oil is not going to be running away anytime soon. Running out. Duvernay Energy Corp, DEC, pure play Duvernay subsidiary. So you can see here the details. Adjusted funds flow for that is 520 million for thermal, and the 45 million. So it's kind of like a smaller initiative from the overall portfolio, and they spend actually quite a lot relatively to the thermal oil. But I think the idea is you spend 195 million for capital, 75 million for the Duvernay Energy Corp, but you kind of scale that and grow production, where the thermal oil is mainly for basically sustaining production, growing brownfield expansion, but it's much lower cost of supply. Where here, maybe DEC, it's more for maybe future divestiture, I'm not sure. But the idea here is like not generate free cash flow. So you don't see that number here. You see 325 million for the thermal recovery schemes, but for DEC, the cash flow is being reinvested back to the business. So here, production by asset, you can see DEC is fairly smaller percentage here on overall production, mainly thermal oil. So the 2 core assets, Hangingstone and Leismer, they have this corner asset. People sometimes talk about corner as the next kind of greenfield expansion, but my understanding from management is that more priority now is on Leismer, not corner. So it's going to be exciting to see. And Duvernay Energy, you can see here on the map, you have this kind of Kebab area, Two Creeks area. There's a lot of neighboring companies that operate in that area. So could be a takeover of that entity maybe in the future. And the management team did not communicate that, but this could be a potential scenario in the future that generates additional value to the company. So for 2025 budget and guidance, so you can see here the thermal oil, DEC, and the consolidated numbers. So production 33,500 to 35,500. So as mentioned before, we're currently at this number as per this month. Probably going to grow a little bit towards the upper range, maybe in the first quarter. And DEC is 4,000 BOEs per day. And consolidated is basically the midpoint guidance is 38.5, and so 37,500 to 39,500. and they basically saying they're going to exit with 41,000 BOEs per day exit. So that's kind of exciting. Adjusted funds flow. So huge adjusted funds flow AFFs for thermal assets, 55 million for DEC, and consolidated 525. Capital is spent 250 to sustain, 85 million for DEC and 335 in overall, and free cash flow get 250. So really, it really depends on oil prices, kind of what that in here we see thermal oil adjustment funds flow sensitivity, but you can get the sense that adjusted funds flow based on kind of this number, they're looking at maybe just like slightly higher than $70. Let's see here an assumption. Yeah, exactly. So US $70 WTI is an assumption, and 12.5 WCS differential. So they're looking at that 475 to 500 as per this scale here. But oil prices now, it's about 74. So this is very reasonable. And then on the free cash flow yield side, recently the enterprise value declined to 2.5. So it was about 10% free cash flow yield. Now it's slightly less. But again, remember that they're spending money to expand to higher production oil rates in the future. And as mentioned here, they're they're going to be exiting 2025 with 41,000 BOEs per day. And that changes that profile for free cash flow yield for future years, because remember, the market is a discounting mechanism, but that growth element should be starting to bake in for future free cash flows according to those production rates. And I think it's important to be mindful of that yield, the suggested yield, is going to increase over time as the production improves through that brownfield expansion projects, which is very reasonable to expect it's going to happen. And so we can see here that the uses of cash, so about 200 million here, maybe a little bit more, right? Base growth, thermal oil capital, and basically their entire commitment for free cash flow, which is that portion, is to buy back shares, which is something they've been doing. They have a proven track record of buying a lot of shares back, which is a good thing. So let's quickly review what it says here on the left side. Thermal oil budget highlights: efficient capital expansion at Leismer to 40,000 barrels per day, competitive and resilient break-evens, operating break-even at $40 per barrel WTI. That's a really low, I would say, industry, like, really good break-even. Like a lot of people talking about the Permian and 45 WTI break-even, 50, 55. Here we have a $40 US operating break-even. Sustaining capital break-even is $50, so which includes the program that we talked about, and growth capital break-even with that additional growth is about 60. So we kind of far away from that with currently 73, 74 WTI and fairly healthy differential. Again, here they assume it's going to be 12.50 based on those assumptions. Robust free cash flow, 100% of free cash flow to share buybacks, as I mentioned before. And the Duvernay Energy budget highlights multi-well pad development with focus on cost execution, growth to 55 BOEs per day by the end of 2025. So here we have an idea of where this company sees itself, right? So let's say if we look forward to the future, the goal for Leismer is to be 40,000 barrels per day. Hangingstone is going to be, now it's 7,500 with two sustaining well pairs, maybe 8,000, maybe 8,500, but let's say 8. And here for Duvernay Energy Corp, so DEC, they tell us it's about 5,500. So we could say maybe once we get to that 40,000 barrels per day Leismer, 8,000 barrels per day Hangingstone, maybe we get to, let's say, 6,000 DEC. So now you could add the numbers. So you basically get 48,000. And so let's say 54,000 barrels per day, right? So 40 plus 8 is 48. Plus 6 is 54,000 barrels a day. Going from 38.5, which is the mid-level guidance for this year, 2025. So that's kind of what what's going to change, and obviously that's going to change the profile for free cash flow. Considering many assumptions, all of these companies are making assumptions to where things could be heading, but in overall, there is this growth profile, opportunity to generate more free cash flow in the future, and very low sustaining capital break-evens, growth capital break-evens at about $60 WTI, and that creates flexibility when it comes to kind of those initiatives maybe postpone a little bit when oil prices decline significantly. So there is this opportunity in doing that. At the same time, the operating break-even is $40 WTI, and we know that many companies in US especially will struggle with $40 WTI. So in overall, I think I like kind of the approach here and the path forward to really showcase to investors that there's not only growth, but there's opportunity for a return of capital in the form of buybacks back to investors. So something kind of to be mindful of as you consider maybe this company. So robust free cash flow profile. What we have here is exactly what I talked about in the previous slide. I guess I could have just done that. We see that increase thermal oil production, Duvernay Energy production, and production per share, right? So, and you can see here kind of long-term 2029, 2025 profile on production, and basically everything we discussed in previous slide. And then net adjusted funds flow, you can see the various sensitivities, free cash flow sensitivity to, and in dollars. So here in dollars, here kind of in millions, I guess. Yeah. So annual sensitivity to 10 million. So $1 WTI changes in 10 million annual sensitivity, and plus 1 WCS is $17 million, as you can see right here. And that kind of delta here between 2025 to 2029, I think the company kind of quantified the net benefit is 1.8 billion free cash flow at US $70 WTI. And so for the next 5 years, it basically says, okay, well, our enterprise value right now is about 2.8 billion, but we're able to kind of net adjusted funds flow generate. So we give you those sensitivities, but we're also giving you basically the 1.8 billion free cash flow estimate if those assumptions come to fruition. So the thermal oil asset with low base decline, Leismer brownfield growth to 40,000 barrels a day, Duvernay Energy enhancement of growth, and I really like that kind of angle where maybe in the future they divest from that asset. So that creates an opportunity, right? Low leverage, 135 million consolidated net cash. So we talked about that. They do have a tax-free horizon, so 2.4 billion of tax pools. Right now, my understanding, Leismer is pre-payout status, and Hangingstone also pre-payout status, which reduces the royalties. And they talk about this pre-payout Crown thermal royalties, 6% at $70 WTI. I really like consistency on the assumptions of $70 because that's kind of where we're at. So that creates a realistic, I guess, expectations based on where we're at currently. But obviously, if it's $80, that number improves significantly when it comes to free cash and adjusted funds. So robust cash flow per share growth, 1.8 billion free cash from 2025 to 2029 at $70 WTI. Again, this is, I think it's important because it kind of gives you sensitivity that enterprise value is like 2.8, right? 2.9 maybe now with 550 per share. So if you're able to generate that's a significant return over 4 years, right? What does it mean about the stock price? Is it the $8 stock then at this point? Is it $9 stock? Depends, right? Depends on a lot of the assumptions for the oil prices as well. But they are committed to that 100% free cash flow to shareholders, 440 million cumulative share buyback since April 2023, resulting in, as they communicated here, 533 million shares, right? So that's the reduction they're at, and I think it's about 528 right now as we speak. So they also say 20% cash flow per share CAGR, right? So that's kind of one of those assumptions for potential return for investors. So now let's overview the thermal assets and look at maybe the Duvernay Energy Corp. So thermal division in aggregate, to talk about their production. So right now, as I said, Leismer production is about 26,000, I think, reported that month. And Hangingstone, it was about 7.5. I think the previous month production was a little bit higher for Leismer, so it's about 26.8 or so, something like that. So don't rely on that. And so if you do a quick calculation, so 26 plus 7, 33.5, 34,000. So that's kind of between those numbers there, the guiding year, which makes sense. So there's no issue that they're producing below that indicated number. And they have 100% working interest on those two assets, which is great. So when it comes to capital expenditures, 250 million spent to maintain those two assets. So AOC Leismer, AOC Corner, that's the greenfield, potential greenfield in the future, and AOC Hangingstone is right here. So as mentioned, $40 WTI operating break-even and $50 sustaining break-even for Athabasca. $8 per barrel sustaining capital, 5-year average. Here we have proved reserves. I talked about them. I kind of estimated 30 year to 60 years. So here they tell us that actually it's 30 years and 70 years 2P reserves and proved reserves. I'm not going to be alive by the time they're done, I guess, extracting. So whether it's 60 years or 70 years, very little importance. But the 30 years proved reserves is a big deal. So 404 million barrels proved reserves are RLI. Leismer first production happened in 2010. Hangingstone first production in 2015. So fairly young assets. I think the one important thing remembering about those assets is that even if you wanted to boost production significantly, you need capex. And this company is committed to returning free cash flow to investors in the form of buybacks. But also they did already announce the capital expenditures program for brownfield expansion. So in my mind, there's very little surprising kind of element here for how come we could be surprised, unless they partner with somebody on the corner asset for greenfield development and announce that. But I just kind of don't see it right now because they're very busy at Hangingstone, basically drilling the sustaining wells. And they're very busy at Leismer, expanding to 40,000 barrels a day for that asset. So the company should be very busy with their activities. So future development for Corner, they're saying 355 million barrels 2P plus 520 million barrels contingent resource, over 300 vertical wells, top quality resource, 40,000 barrels per day regulatory approval. And that's an interesting angle here, is that seems like they already had a delineation program where they drilled strat wells to basically poke the pay, those vertical wells, understand what's in situ, and being able to develop the resource at 40,000 barrels a day with their regulatory approval in place, which will become essentially another Leismer. And it has this very similar, if not maybe slightly better geology in that kind of I would say northeast corner, I guess, between them and that Enbridge terminal there. And obviously they have this coupling, the pipeline connection through that AOC Hangingstone location to Cheecham terminal. So we see kind of the map integration and obviously other producers in the area. So we have the Christina Lake here, Jackfish, right? So very good geology in that area, kind of, I guess, southeast corner. To Corner and Leismer. So as we talk about Leismer review, we have a big step change here, going to 40,000 barrels a day on the sanctioned 40,000 expansion. The base production, as you can see, will be sustained at this 28,000 barrels a day level. I guess that's kind of where they're aiming to be right now. And SOR, so steam to oil ratio, is expected to be somewhat flattish here, just around 3, which is not too bad. And on the map, we can see that pad 8 L8. I think in my mind, L8, and this is my personal view, is one of the most important things that happened to this company. People sometimes wonder how come this company it did it so well in the last couple of years. Well, big portion of that it was PED L8. PED L8, my understanding now, is making maybe north of 12,000 barrels a day. This is a big chunk of that their 26 to 28,000 barrel a day production. So all those wells here that they're currently drilling, doing ridge drills and kind of redevelopment a little bit of those wells in this kind of main area. But PED L8 really showcase that this company has much better geology than initially thought, and much better pace and much higher kind of production rates. I made a tweet about that some of their wells they're producing over like 1,400 barrels a day, which is a really, really nice achievement. And this really could be proven in the sense where they're telling us that they're going to develop PED 10 with 4 well pairs adjacent to PED L8. And you can see they really expanded PED L8 across the kind of the lateral sections as they continue drilling those wells, and PED L11 in the future. Also, in expansion in this whole kind of holistic area of this geology, which is great. Like really nice production rates, really de-risked geology in that area. So I really like that. And obviously, the central process facility is right here. So it's all coupled to steam, the emulsion, back to CPF to be treated. So with the expansion of 40,000 barrels a day, going kind of towards that like 2028, 2029 timeframe, getting that asset, and I'm very excited about that. I think especially with SOR staying kind of flattish here, this is pure value added to this overall development. And again, one of the nice things about those type of assets, like for example Hangingstone, you'll have only like 25 producers, right? Here you can see maybe like 60 producers, something like that. Don't take my word for it, but it's very simplistic in a way, like very simple to understand. Those are the wells, those are the production rates. The average production rate per well is, let's say, 300 barrels a day, something like that. And you don't deal with those other companies that have like 1,000 wells, 2,000 wells, and they produce maybe 20, 30,000 barrels a day on significant amount of wells, which is a liability in a sense. So just to kind of summarize, Leismer, top tier oil sands project, long reserve life, 7-year current reserve life index, 697 million barrels, 2P reserves, 384 barrels, best estimate contingent resource, 50-year 2P RLI at 40,000 barrels a day, which is important to consider because you need to consider the flow rate and then translate that to years. How many years they're going to be producing that at that specific rate. Excellent reservoir underpins low corporate decline, which is not, companies will just sometimes say things like that, but in their case, they actually were able to prove that this is really the case with their company. Excellent. So new wells have flat production profile for 5-7 years. I'm really monitoring this, really paying attention to that this is the case. Legacy wells showed similar kind of very low decline rates, so that's very good. 3 times long-term steam oil ratio. So they basically are talking about SOR being 3. So as we can see here, so SOR 3. I think with NCG co-injection on kind of the legacy wells, they could possibly reduce it a little bit further, but maybe they're seeing some things there with the kind of gas handling, so it's okay. I understand. SOR 3, not too bad. Q3 2024 operating netback, $50 per barrel. This is an excellent operating netback in a price environment that wasn't, very beneficial to producers, but $50, I'll take it. Low pre-payout crown royalties of 5 to 9% until 2027. So again, when assets, they basically pay their capital that they spend on development of the assets. There's an equation with revenues, the way government basically looks at those assets pre-payout, post-payout. There's a percent assigned to it. I think once you go post-payout, you need to pay over 30%, I think, something like that, in post-payout crown royalties. But here you have a really good torque towards kind of like lower spend, and money that you don't spend, you get to keep, which is excellent. So both of their assets, Hangingstone and Leismer, they're pre-payout. 2025 base activity, so 235 million, tying 6 redrills and 4 sustaining well pairs in H1. So the company is very busy with the redrill program and sustaining well pairs to sustain production. Initiate development of pad 10, 11 in H2. So again, this area, and why are they there? Because L8 was such an important pad for them to develop. I'm so happy for them that this pad is doing so well. Facility expansion to 40,000 barrels a day. Again, that's the longer term plan for this asset. And phased growth. I love that word, phased growth. So just phase into things, don't do anything extreme. Highly economic, internally funded, 300 million project capital over the next 5 years. Next 3 years. 25,000 per flowing capital efficiency, inclusive of facilities and well pairs. So 25,000 per flowing, brownfield expansion to add additional 12,000 barrels a day to get to 40,000 barrels a day. That's pretty good, because if you think about this now, company enterprise value is, let's say, 2.8 billion, and they produce about 38,000 barrels a day. Well, that translates to maybe, so let's calculate that. Let's not speculate. So let's say 28,000 divided by 385. So about 72,000 per flowing. And the development is 25,000 per flowing. So if I was to say to somebody, you invest 25,000 in something, and the value after, let's say, 5, 6, 7 years, you get an asset that's valued at 70,000 per flowing. So there's a certain logic to those barrels being kind of that investment of future cash flow generation, which makes sense to me. Okay, so we're at about 30 minutes. Let's see. The Leismer 40,000 barrels per day expansion, historical production growth outlook. So 2022 we're at 20,000, 2023 improvement, 2024. You can kind of see the trend, right? So they're gonna exit 2027 with 40,000 barrels a day, and we specify the project cost, which is 300 million, incremental rate 12,000 barrels a day, capital efficiency 25,000 per flowing. Leismer NPV10 for 40,000 barrels a day is about 3.1 billion. I talked about this I would say 2 years ago, about this number. Now we see this number is official. My language for that was that the entire enterprise value for this company, current enterprise value, is going to be Leismer. Well, that's roughly where it's at. So essentially, if the plans go according to what's being planned here, what's being shared, we're looking at a company that's currently trades at one of their assets value in the future. So essentially, we get the Duvernay Energy Corp and Hangingstone essentially for free, with the tax pools, very low royalty rates, and the buyback initiative that's been going on now for some time. So when people talk to me about, hey, I'm shorting this company, it ran too high, it ran too fast, whatever, I can't really take them seriously because I have to look at these numbers and really make a conclusion, like what's reasonable here. And when I see that NPV10, that assumption, economic assumption of NPV10 at 40,000 per floor, at 40,000 barrels a day, results in $3 billion. Well, that's the current enterprise value. Enterprise value actually right now is like 2.8, right? So 3.1 is even more. So one must be mindful of kind of the actual numbers, and that they're realistic, that it's achievable, that there's a proven track record, and not being emotional about it, just kind of, seeing, is it reasonable? And I think it is. So what's completed? So they completed regulatory approval for 40,000 barrels a day, no egress expansion required, established transportation to Edmonton, long lead steam generation acquired counter-cyclically. So during COVID, it's kind of funny. They acquired that steam gen, and the steam gen is going to be used for the 40,000 barrel a day expansion project. Remember, they have to generate steam capabilities to steam the new geologies to bring the incremental oil production. And so that was acquired at the bottom of the cycle when everybody were panicking during COVID. So I really applaud the management team for taking that initiative. So central process facility capacity expansion, they're gonna bring it to 130,000 barrels per day steam and 200,000 barrels per day emulsion. Now, the way to look at this is you got to consider the water cut in the emulsion. So this, because you inject the steam, it will become water. So now you need to separate water from steam, water from oil, and oil goes to sales, and water is being recycled to generate more steam. And that steam, 130,000 barrels a day, that's a function of that SOR, right? So if you want to produce 40,000 barrels a day of oil, well, you got to time it by 3. So what is that number? 120,000 barrels a day of steam that's required. Well, the generating capability of 130,000 barrels per day of steam. So, and let's take a look at the water cut. So if they're able to cut the water cut, let's say to 75, and they're planning on 200,000 barrels per day. So let's see. So we're getting, so 150, right? So then it's 50,000 barrels per day. That's interesting. And if you get water cut of 80 for the 200,000 barrels per day, you get about 40,000 barrels per day. So the assumption here is water cut for that emulsion flow rate is 80%. So I'm gonna have to check the number, see where it's currently at to make sure it's a reasonable assumption. Hangingstone overview, very simple asset. I love that asset. Many people thought that this asset is worth 0, but it's not. This asset is doing quite well. I made a tweet about that post on Twitter. Maybe you guys can go and kind of take a look at under Razor Oil, and talked about those 25 whelpers that did absolutely magical job during COVID. And obviously that future whelpers, current whelpers that they drilled and future whelpers they're going to integrate by re-drills and kind of that expansion here to the existing geology, which is, by the way, it's great because the steam chambers are already coalesced in those regions here, and the heat transfer been already made here. So you kind of get that incremental value as well. But SOR is slightly elevated, so I think it's about 3.5 here, it seems. But and now we're in 2025 right here. So now they're basically expecting this thing to decline, even though it didn't decline that much up until today. We're currently at those levels, 7,500. So I think their assumption is a little bit more conservative here based on current data. But let's say we get that. So I think like what's happening here is maybe they're under promising and over delivering, but I will kind of let things be the way it is and kind of happy about that. But long story short, long reserve life in this asset. So 65 years reserve life index, 167 million barrels to P reserves, improved SOR due to field-wide NCG co-injection. I love this topic of NCG co-injection. I'm going to be teaching a class, capstone class at SAIT about this topic, NCG co-injection. This is really a good initiative when it comes to reducing steam requirements, when it comes to cutting energy intensity, when it comes to reducing emissions. It's kind of like a win-win-win technology. The challenge there could be is that it's non-condensable, and when you have something that's non-condensable, you have all other kind of issues that could come from that. And they talk about SOR about 3.4. I said about 3.5, so it's gonna kind of fluctuate here for us. But I'm really glad to see that SOR is not increasing, because that SOR prior to 2022 was much higher. So the company actually did an amazing job cutting their steam to oil ratio. Okay, 2025 activity, $15 million, so not much. 2 new extended reach sustaining whelpers on production in Q1. So this quarter we should expect those red wells right here. So those red wells right here, right there, to sustain production here so it doesn't decline. And I think it could be done. I love that. I love the extended nature of those wells. They're basically essentially coupling pad AE and pad AA together. So that could be kind of cool. I love that idea. Really smart reservoir engineering activity there. Planning for future well pairs 2026 and beyond. Maintaining strong netback and cash generation. When it comes to cash generation, 325 million operating income generated between 2022 and 2024 with minimal capital. And it's true, they didn't spend much money at all on this asset. Operating netback $48 per barrel. Low pre-payout crown royalties, 5 to 9% into 2030. And again, minimal royalties, minimal taxes, high netbacks. Not a perfect geology by any means, higher SOR as mentioned, but they're making money. It's a good asset. Corner overview. Wow, how many slides we still have? Oh, appendix. Okay, not too bad. So quickly, let's do corner overview. So top tier oil sands project. So it's kind of located in the north east corner of Leismer. A large de-risk asset, 355 million 2P reserves, 520 million barrels contingent resource. Again, you can see in the dots here that they explored this area already. They know the geology. The money was spent on those vertical wells. So they already drilled over 300 vertical wells and 80% of the 3D seismic. So they know exactly what they have in that resource. High quality reservoir up to 45 meters pay of initial development with high quality sands. Expecting to fill 20,000 barrel a day facility with one pad, 16 well pairs. So expect to fill 20,000 barrel a day facility with one pad, 16 well pairs. That's like a big statement here. Analogs to Christian Lake and Jackfish. Wow. This is a massive statement here, guys. I need to moment to kind of even digest what. So if you produce 20,000 barrel a day on 16 well pairs, okay, what does that look like? So 20,000 divided by 16, so about 1250. So they have right now in Leismer here, they have wells that produce 1,400 barrels a day. So I believe that. Wow, that's good. Anyway, regulatory and infrastructure approved for 40,000. But again, the challenge is the capex, right? Because if you want them to buy back shares, if you want them to do well when it comes to being shareholder friendly, they can't take all this money and now develop corner. And that's kind of I think that's the ultimate challenge for all of these companies, all of the oil and gas companies, all of the future development is that all these companies that compete for investors need to come to the table and invest their dollars. If there is no return, if there is constant capex reinvestment ratio increasing back to producing more oil, then people are thinking, well, Nvidia gives me that, right? Like I don't know, Fartcoin is up like 500% this month. Well, like, why do I need to wait when this pad is going to get developed and then maybe get my return? And maybe they're looking for partners, I guess. I don't know, for the development, but I'm very excited about corner, but not very excited about capex spent, I guess. That's kind of my personal view. But we have Leismer that's going to 40,000 barrels a day. That's remarkable. I love that. So pre-sanction activity. Pre-sanction activity, updated development plans, incorporates current well design at Leismer, tested clear water to confirm viability of disposal near the central process facility. Facility engineering study completed. So the company is making kind of like greenfield development plans, but without actually pursuing that right now because they don't need a lot of money to pursue that. Exploring modular design option for improved efficiency. Funding expected to be sourced externally. So their commitment to free cash flow to buy back shares from Leismer, from Hangingstone, still intact. the Duvernay Energy Corp free cash flow is going to growth in that area, maybe to divest the area. Could be interesting angle here. And again, I maybe sound like Nostradamus now, but what if they're able to grow Duvernay to a certain scale where it will be attractive for the investment, and then they take that money and greenfield spend capex on corner expansion from the money. So net, you basically took that and converted that to corner. This could be a very unique angle here. I never actually thought about this way, but this could be the play here. But I'm just speculating. I don't know. Okay, back to Duvernay Energy Corp. So this is now its own entity. They did something very smart. So equity ownership, you have 70% AOC, 30% CVE. So Cenovus partnership there. I think it's kind of a big deal. People didn't talk much about that angle where a huge major company comes and partners with such small company as Athabasca. I think it's a very nice achievement for management to be able to develop such partnership, JV partnership, which creates value to investors and potential opportunities in the future. So 2025 estimated production is about 4,000 BOEs per day, and 2025 exit rate is 5,500. Capital 85 million, Q3 liquidity 88 million. So I'm thinking, so liquidity including cash 88,000. Yeah. So what I'm thinking here is, okay, like let's say if they were to, we have many. So let's look at this map and kind of investigate. We have many interesting neighbors here. Okay, so the DC 30% JV assets, we can see them in red. Now we have Varen here, Crescent Point, Paramount, more Varen, Chevron here. Chevron. Maybe it's CNQ now, right? PetroChina. But eventually, I mean, all kind of roads on this map, they lead to one neighbor here, which is kind of Varen, but in Paramount and GMT exploration, which I don't know much about. GMT exploration. So I don't know. A very interesting kind of location here when it comes to potential future strategies. Meanwhile, they can just grow this asset and generate cash flow and reinvest that in growth. This is, in a sense, becomes very insulated to what's happening in the thermal assets, where that cash is being converted to share buybacks. Okay, so Athabasca and Cenovus combine Duvernay assets. Athabasca operates DEC, unparalleled exposure to Cape of Duvernay oil window. Cape of Duvernay became extremely sexy asset in the last couple of years. Many players kind of looking at this, and we've seen some transactions in this area. Asset highlights: 200,000 gross acres, 500 gross well locations, 48,000 acres, 100,000 working interest, newly operated position. Industry leading netbacks, $44 per BOE in Q3. I think Hangingstone was about 48. Kind of gives you a perspective, right? Because I think Hangingstone is not a bad asset. It's actually really good, even relatively to Cape of Duvernay. So kind of going back a little bit, reiterating, I guess, my bullishness on Leismer and also on Hangingstone, but especially on Leismer. Catalyst to accelerate value creation, self-funded development within DEC with growth to 20,000 BOEs per day, where you get 75% liquids in late 2020s. So that's kind of the vision. The vision is have another 20,000 BOEs per day. So what I was saying earlier is not actually even correct, because we're going to have 40,000 from Leismer, let's say about 8,000 from Hangingstone, and here they're saying 20,000. And let's simplify and say that 8,000 Hangingstone is being converted to 10,000 barrel per day asset. So now this entire company has potential of being a 70,000 barrel a day company. BOEs per day company in late 2020s. That's kind of the dare to dream potential. And the 10,000 barrels per day in Hangingstone is very doable. They've been kind of in similar oil rates before. It just requires, as you know, smart integration of, I guess, refill and infill wells, similarly to what Greenfire did in their demo and expansion assets there, especially on the Hangingstone expansion asset. So if they follow that kind of template, they could achieve a lot of value. And we know now that Greenfire shares being acquired by Water's Energy Fund, and who knows, maybe one day, and that's kind of my prediction, they're going to end up as part of Strathcona. So that creates a very unique environment for a company like Athabasca, where you have, you know, several moving parts, but they're all very, very managed, very well understood, very intentional. And I'm sorry, guys, but I just love that. I love that angle here of the redevelopment. Even when we look at developers that don't have those infills or refilled wells, I see that as an opportunity as well. So here we have this Duvernay Energy Cape activity map. We have oil window, we have liquids rich gas window. You can see where the DEC is located. Again, numbers include CNRL, GMT, Quintoc, Paramount, PetroChina, Varian, even White Cup in that area right there. So that creates an opportunity, right? Like even if you sell maybe partial DEC asset in the future, maybe for a very nice return on per flowing metric, right? Maybe you keep half and continue redevelopment. I just kind of love the opportunity. And remember, in its heart, Athabasca Oil is a net cash company, right? So this DEC entity is kind of has its own entity, and it drills wells based on the generated cash from the wells that produce. So it's basically rewards its expansion program by saying, I'm making good decisions. I drill those wells. I made the money. I'm going to drill more of those wells and then grow it to 20,000 barrels per day, BOEs per day by the end of this decade. So, so I like that approach. It creates almost like a sense of discipline. It creates a sense of a really true growth company that, you know, historically we've seen in oil and gas, while Hangingstone and Leismer is a kind of cash machines that reward buybacks. So Duvernay Energy Corp 2025 activity, 85 million capital, 100% working interest operated activity, complete 3-well pad in the first quarter 2025, multi-wet pad spot in on stream in 2026. They have this 30% working interest JV activity for well pad spot in Q1, on stream in August 2025, multi-well pad to spot fall on stream 2026. And we can see some illustrative economics, right? So IRR is 85%, 178% on the kind of larger scale development. Payout 7 months, payout here is 13 months, and PI 1.1, 1.9, recycle ratio 3.3, 4.6. So, and liquid yield in both 78%. And again, if we there's a little bit torque here towards higher oil prices. So if we get higher oil prices, it improves the payouts and the rate of return. And when it comes to long-term activity, development plans to be funded within cash flow and flexible for a range of commodity prices. Impactful activity on DEC's 100% working interest acreage, augmented by JV activity on DEC's 30% working interest acreage. A deep drilling inventory with growth target to 20,000 BOEs per day, 75% liquids in late 2020s. Again, the idea here is to self-fund, but I'm getting repetitive at this point. And here you can see the type curves, right? So the first 3, 4, 5, 6 months, you kind of get in that window of higher oil rates, but then you decline. And that's one of my challenges with a lot of those companies that say, well, our decline is the lowest in the industry when they operate here at the tail, right? Well, obviously, on relative basis, your decline from year to year is much less than decline from year to year. And in a way, it's not being very kind of mindful of that the investors do have intelligence, right? So, but something to keep in mind on for people that listen to this is that you really need to check kind of those type curve profiles for the companies. And in the case of Duvernay Energy, they're going to be coming up here with new wells, and they're going to be capturing the value here. And now we see oil price improvement. So timing those things is never an easy thing, but it does provide some torque. So here they talk about why to own Athabasca holistically, and I think I'm gonna skip that slide and show you a picture here of, and maybe let's keep it here so you maybe can take a look a little bit later. But yeah, they do have net cash. They do have a lot of reserves. They do have long life assets with low decline. The free cash flow, 1.8 billion, what we talked about, at $70 WTI by 2029, and returning 100% of free cash flow through buybacks, 20% cash flow per share CAGR. They do have kind of this angle towards integrated sustainability. Now, many people can roll their eyes and say, well, I don't care about that. But reality is on Hangingstone, they did a really good job cutting emissions, cutting SOR, by utilizing NCG co-injection and maintaining production rates at levels where the decline is not as steep, so which is very great. So good job. Okay, so we have a beautiful picture here. So let's kind of quickly conclude that specific presentation. So we're just like under 1 hour, and maybe let's go to the first slide kind of to summarize what we talked about. So today we covered, and this is kind of in the near term, what to look for Athabasca as a company. I like this company. I think they're doing a good job. I think they have a proven track record in recent years that they can execute. Right now, it's a $2.9 billion company. Obviously, net cash position helps a lot. They do have more cash on the books than the net cash, so 335 million net cash, but they keep some debt at lower interest rates. Expect production of 38,500 BOEs per day in this year, 2025. Leismer, longer term, going to go to 40,000 barrels a day. Hangingstone, I think it's going to go to maybe 8,000, 8,500. But the plan right now is just to sustain production at Hangingstone and just kind of collecting that free cash and buying back shares. Obviously, DAC, we talked in detail about Duvernay Energy Corp and the plans there, with Varen being a neighbor, with Whitecap being a neighbor, others, right? So it could get exciting here. And obviously, from thermal oil, 325 million free cash flow, divide by 550. Now you get, let's actually do that quick exercise. So 325 divided by 550, the current share price. So 59 million shares, yeah. So 59 million shares. Right now we have 533 million. They have NCIB at 10%, roughly. So you see how the numbers just align? They just align. So hard to see the blind spots here. Let me know in the comments if you see any blind spots. Let me know if it was useful. Let me know your thoughts. I always care about that. And yeah, appreciate you following this presentation on Athabasca. And again, not financial advice. This is publicly shared information for educational purposes. This was more of a study to better understand. I did express some bullish views here on several things, but only because the company showed us that realistically they execute, right? Obviously, it's not perfect. Things happen, right? Like many people complain about dilution of the kind of by shares, by issuing shares, management, things like that. Some management selling shares. Some express their views about that. But hopefully we're on the right path here, and I really like that slide deck. So we're just getting here to in 1 hour of presentation. So thank you so much. Hopefully it was of value to you. All the best.